One thing you can do with cash at the moment is stick it in an ISA, but that might not be the case for much longer, at least not if you have the same levels of cash that Steve does knocking around. So Rachel Reeves is planning on, or at least there are reports that Rachel Reeves is planning on, reducing the cash ISA contribution limit from £20,000 to £4,000. The idea is to get people to stop hoarding cash, so stop giving them tax incentives to do so. This doesn't suit, as has been reported in the papers, some people who are perhaps in their retirement and don't want to be in the stock market and don't want to be invested because they may want to draw down their savings. And they will they run the risk, if they do that, of having the market go down at a time, which means they have to sell out more of their portfolio than they'd like for less money. That's a genuine risk. That's something that we're always quite aware of. We tend to think that because we have a long-term view, we can sit out any downturns. If we were in a situation where we couldn't sit out any downturns, we would think carefully about what we put in the markets. And we do tend to, both of us, make sure we have a big enough quote-unquote emergency fund to see off anything that might come about here. Broadly speaking, I'm pro this with a couple of caveats, but Steve, what did you think about this idea, or at least this idea as it's being discussed at the moment?
Yeah, I'm broadly pro it, Steve. And again, I've got a couple of caveats as well, and I'll go for mine first, and then we'll go back to you. But there's about a third of the UK has a cash ISA at the moment. It's about 300 billion sitting in them, and the issue that the government has there is basically they want the UK to have an investment culture that's kind of like America's, where there's more people who want to invest in equities, invest in UK equities. It's one of the ways I think they see them being able to revive this UK stock market, which has been stagnant for a while. Only I think 10 IPOs in the last year versus the hundreds that have been in Europe and in America. So one of the problems you have, though, is that the ISA market, the cash ISA market, actually funds partly funds the mortgage market. So if we cut down on ISAs too much, and additions to ISAs too much, and house prices continue to go up, we might find it that the mortgage market becomes a little bit tighter, which is like one of those unwanted sort of bugs that you get in the system by doing this. Oddly, with all of this talk of ISAs having a pretty dodgy future ahead, Hargreaves Lansdown put out some data the other day, Steve, that said that they're actually flourishing at the moment. They had a record year for in 2024 and a bit of an early start to cash ISA season as well. So something to do with frozen tax thresholds and people having to start paying tax on their savings because the rates are so high. And it's much easier to get there. A lot of people are looking to use a cash ISA. I don't use a cash ISA. I have used one this year for a brief period of time, but I transferred that out within about a month of opening it because I had some cash that I thought I might need short term. Turns out I didn't, and then it went straight into my stocks and shares ISA. So yeah, I think it's an interesting thing, Steve. I think it's a good thing. I think a lot of people have taken this story really badly, Steve. The takes I've seen on the Trading 212 community have been laughably bad. Getting people to stop putting money in a cash ISA and encouraging them to put it into a stocks and shares ISA, that's not trying to keep the common man down. It's trying to improve the lives of people by getting them invested. It's not about shoving you back down the coal mine. It's about helping you be less of a burden on the state. Unbelievably, people seem to think that the government want to tax people so much that they become a burden on the state, and it's actually the opposite of every government wants to try and alleviate that, and they have different ways and means of trying to do that, and some are successful and some aren't, Steve. And it's not really for us to judge at the moment. We judge them at the end of their periods, whether we decide they've done a good job or not. But judging them now is strange. So I think Rachel from accounts needs a bit of a break on this one, Steve. She hasn't said she's even going to do it. She just said it needs looking at. So we'll see. What are your thoughts, Steve?
It does need looking at, and to some extent, this is related to. I mean, the previous government had a crack at reforming ISAs. The British ISA, we talked about it on this show. It never quite saw the light. It never got near seeing the light of day. Actually, let's be honest. But look, it was an attempt at reforming ISAs along the way. And there's been kind of moves made on this. So I'm broadly speaking on the side of this. I'm also mindful that the Chancellor has plans to try and incentivise banks to lend, not quite in a sort of think 07, 08 sort of way, but that's an important part of getting the economy moving, making capital available for investment. And as you point out, then a lot of that's going to come from banks, and banks will mostly want to do this from consumer deposits. So Lloyds, we tend to think, has a decent sized advantage over some of Barclays and NatWest by just having a bigger deposit base. Why is that an advantage? Well, because you don't have to pay much interest on deposits. If you think about what you get on your cash ISA, if you have one, it's not an awful lot, and you could generally lend that out if you're a bank to someone else at a reasonable rate for a mortgage or even a business loan as an investment project. Charge a kind of nice interest rate and get yourself a decent margin, and that deposit will probably stay with you because people don't really pull down their cash ISAs if they can help it, because you can't replace them, and there is a tax advantage to keeping them there. So providing this doesn't cut off banks and their kind of lines of capital available to lend, which I don't necessarily think it will particularly. I know we talked about how much is in them, but over in the States, they don't really have a similar sort of thing, and the JP Morgans of this world don't seem to struggle for lending. The alternative would be they'd have to do it by issuing bonds of their own, paying interest on those, which would be higher than what they pay on your current account. If you compare what Lloyds would offer you on a cash ISA compared with what you get buying Lloyds' debt, you'll find you stand to make a lot more money by buying the debt. But so joined up with the plans to kind of help the banking sector along and maybe lighten restrictions on that a little bit would be one kind of view. And the other is I generally dislike it when governments of any sort, whether it's this one or the previous one or whatever the next one will be, start trying to change things that were put in place before and then apply them retrospectively. So I think anything that's currently in a cash ISA has to be allowed to stay there. You can't start taking things back out of tax advantage wrappers. And if people had stuff that they put in there on the understanding that, look, this was the way it's going to work, I think you have to live by the promises made by a government that wasn't you, that you may have disagreed with, and so on and so forth. But you have to inherit the situation that you find, whether you're Labour trying to take over from a Conservative government or the other way around. You can change things for the future. You can say from next year, from April, from whatever, no, it's going to be 4,000, not 20,000. And people can like that or not like it, and then they can vote accordingly. But I haven't seen any signs that they're planning on particularly reversing this decision and applying it sort of backwards, the way that Resolution Foundation, I think, wanted a general limit on ISAs for a lifetime of 100,000, and that would have, I think that might have looked kind of backwards in this situation. But broadly speaking, I'm on the side of this, and I think people would, largely speaking, stand to do better by being in stocks and shares ISAs, as long as they can hang on there for the long term.
I think the key point, Steve, to finish on, is if stocks and shares ISAs, if you have a cash ISA, I suppose, and it gets limited to 4K from April, and you want to put some money in a stocks and shares ISA, you can go out and buy bonds or money market funds, which will perform, with a bit of luck, very similarly to the market rates that you would have got on your cash ISAs. So there are ways and means to make this happen without taking on huge amounts of risk.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.